Friends, then we are going to start today's discussion. Uh, this concept of significant economic presence and this levy of equalization, or the equalization as it is called. I mean, both are concept which has evolved to address the concern for base erosion and profit shifting, which is known as BEPS in short, to tackle the challenges relating to digital economy. Now, due to this digital economy, as I was discussing in the previous sessions, that the country of source where the income arises or accrues, that has the first right to taxation. Then whatever amount is taxed by the country of source, it is adjusted. This concept of significant economic presence and the concept of equalization levy, both are a concept which has which have come into being to tackle or address the challenges arising out of digital economy. And the Organization of Economic Cooperation and Development, OECD, they published a report titled Action Plan on Base Erosion and Profit Shifting in July 2013. And therein, this plan identified 15 actions for addressing the challenges arising out of the digital economy. And Action Plan 1 report unveiled three alternative options or alternatives to address the taxation issues of the digital economy. First being to develop the concept of significant economic presence. Secondly, withholding tax on digital economy. And thirdly, introducing equalization levy. The Central Board of Direct Taxes constituted a committee for taxation of e-commerce in 2016 and to tax issues arising out of digital economy, specifically considering the OECD's report on Action Plan 1. So India is one of the first and foremost country in the world to tackle this, which has introduced the several provisions or taken several steps to tax the concerns arising out of the digital economy. As I have discussed in the previous sessions, that it is the country of the source, that is the country where the income accrues or arises. That country has the first right to levy tax, and the country of residence, the country of tax residence, not the citizenship, the country of tax residency, that country taxes global income, but in accordance with the double taxation avoidance treaty, FANI, a deduction or adjustment of tax paid in the source country is allowed in the country of residence. Now, in previous sessions, I have discussed the concept of permanent establishment, that if a individual or a company has a permanent establishment in another country, then whatever income or accrues or arises through that permanent establishment, that get taxed in the country in which the permanent establishment is situated as a business income. Now, in the present digital world, it is not necessary that a country opens a branch or a physical office to conduct business or do transaction in a particular country. They may very well do the entire business through the digital means without having any significant without having any permanent establishment, without having any physical setup, and thereby the country in which the economic activity is happening, that country is unable to levy tax in the absence of permanent establishment. So to tackle all these kind of challenges, the concept of this significant economic presence and this equalization levy came into force. And as far as the Indian income tax is concerned, this concept of significant economic presence was introduced in the Income Tax Act in 2018, that is from 1st of April 2018. Now, you see, at the time of the introduction of this concept of SEP provisions, the memorandum explaining the provisions of the finance bill referred to the taxation of digitalized businesses, and the intention appeared to be to tax transaction undertaken only through digital means. However, the language of the section which was finally introduced goes much more beyond the scope as was intended, and presently it says that an explanation section 2A to subsection 9 of the Income Tax Act was introduced, wherein the Indian tax jurisdiction has right to tax income accruing or arising which results in business connection in India for a non-resident. Now, this concept of business connection was expanded through this concept of significant economic presence, wherein it was stated in explanation 2 capital A that transaction in respect of any goods, services or property carried out by a non-resident in India, including the provision of download of data or software in India, if the aggregate of the payment arising from such transaction or transactions during the previous year exceeds such amount as may be prescribed. Secondly, systematic and continuous soliciting of business activity, engaging in interaction with such number of users as may be prescribed. So as you can see, with respect to both the things, whether it is transaction in respect of goods, services or property carried out by a non-resident in India, the liability of a non-resident to become taxable in India arises depending on the transaction exceeding certain amount. Similarly, if a systematic and continuous soliciting of business activity continues in India in excess of certain number of users, then also this significant economic presence concept gets attracted. Now, the limit which is prescribed in Rule 11, capital U, capital D, with respect to payment made to a non-resident is 20 million in a financial year, and threshold in respect of the number of users is 3 lakh. So if a non-resident receives more than 2 crore during a financial year, or he interacts with more than 3 lakh users in India in a financial year through digital means, then this concept of significant economic presence gets attracted, and it will be deemed that such a non-resident has a business connection in India. Therefore, out of such business connection, whatever income is accruing or arising in India or is attributable to such business connection will be taxable in India.
Sir, sir,
Hello.
hello.
Yes.
Sir, one question. Sir, it
Yes.
means the software like YouTube and all other software, I mean, the other software which we are using, which are
Correct.
in India very popularly, their income will be
Right.
charged to tax, na?
Yes, 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 yes. Because they are interacting with the number of users exceeding that threshold. So obviously, if the YouTube is earning its revenue through India, it is supposed to pay tax in India or Google or any other.
Any
You
other
see,
platform.
yes, correct.
Super duper.
Instagram, Facebook, whatever it may be.
Correct, sir. Correct.
Thank
The,
you, thank you. So a very pertinent question asked by Mr. Pandey at a very crucial juncture. I mean, this is what makes the session more fun and more interactive. So now the question arises that India has number of double taxation avoidance treaties, wherein the taxation is levied or not levied depending on the existence of a permanent establishment. Because as on date also, the double taxation avoidance treaties have not captured this concept of significant economic presence and all that. So double taxation avoidance treaties still continues to operate in that old physical world. So if India has a double taxation avoidance treaty with a country, and if this any of these entities operates in India through that uh, has a headquarter in any of those countries, then the benefit of double taxation avoidance treaty will accrue and it will override Section 9. Because you know very well that whatever is more beneficial to the SAC, whether the provision of Income Tax Act or double taxation avoidance treaty, that will apply. So this is a pertinent point which must be kept in mind, that not that it attracts everything, but only if there is no double taxation avoidance treaty with other countries, then this significant economic presence is more, you see, taxing. Otherwise, even if it is taxable under Section 9 by virtue of this concept of economic presence, but one may get out by taking the advantage of the double taxation avoidance treaty.
sir, one more question, sir.
Yes.
Sir, suppose there is double taxation at PT is there.
Huh.
If anyone is earning, uh, say I'm asking the question from the prospect of resident. Is it
Right.
allowed? Can I ask the question now?
Yes, yes, yes. Tell me.
I'm resident here in India and I have earning also in US.
Hmm.
US charge tax on citizenship basis. If I'm citizen of US also, then I have
Hmm.
to pay worldwide income in US also. And on
Correct.
the basis of my tax residency, I have to pay tax in India because I'm resident
No,
in
no,
India. So
no, no.
worldwide income will also charge the tax in India also, sir.
No, no. You see, on the basis of citizenship, nowhere in the world uh, you see the taxation is done on the basis of residency, the citizenship. You have to go through the double taxation avoidance treaty, where suppose you if you become the uh, because of the local laws, the you
Ji.
become resident of two tax resident of two countries, then there is a rule for tie breaking, which I've already discussed in the previous session. It is available on the YouTube. So whichever
Okay.
session I do, it is always available in the YouTube, so you can check it. So I have
Sure, sure.
already clarified that suppose if you become tax resident of two countries, then you can take the benefit of the tiebreaker rule, and ultimately you will be tax resident of one country only. And if you are having a global income, then even if you pay tax in say country A, B, C, but you are a tax resident of country D, then you will get a deduction of all the taxes paid in A, B, C in your country of resident, which is country D. So that is how the
Correct.
international taxation laws operate.
Correct, sir. Correct. I will check, then I will revert to you. No, thank you very much.
Right. So non-residents, uh, so as I was discussing that it applies if there is no double taxation avoidance treaty. But if there is a double taxation avoidance treaty, then that non-resident may take advantage of that uh, double taxation avoidance treaty. But as far as Mr. Earlier question of Mr. Pandey is concerned, that nowadays even this most of these digital companies, they do have an office in India, because there is so much of I mean business opportunities in India. For example, this YouTube and this Google or Instagram or Twitter or whichever these platforms you name, they have an office in India, and therefore these companies are concerned, they get taxed in India on the basis of permanent concept of permanent establishment, and not on the concept of significant economic presence, because most of their companies have their headquarter in US, with which India has a double taxation avoidance treaty. So they get out of this concept of double taxation avoidance treaty, this concept of significant economic presence because of this DTAA, but ultimately get taxed because of them having a permanent establishment in India. Now, one of the unintended consequence of this SCP provision is that large number of non-resident gets covered in this concept, because you see, even though the objective was to tax the digital economy, but the manner in which the provision explanation to capital A of section 9 is worded, it just does not restrict itself to business transaction. And as I had discussed in my budget session last week, that now with this budget, uh, the only the if there is only a transaction with the Indian citizens or Indian residents for the purchase of goods for export outside India, then it will not be covered within this concept of significant economic presence. Now but another problem is that even if you are a non-resident and you are covered by the provision of DTAA, still you must comply, strictly speaking, you must comply with the income tax laws. You will have to file an income tax return, claim the benefit of DTAA, and have a certificate of a chartered accountant so that you get out of it. Because ultimately you have to produce that tax residency certificate with the country with which this digital company or whatever, whosoever non-resident is doing business in India in excess of the prescribed limit, uh, to claim the benefit of double taxation avoidance treaty. So this is very important to have the compliance is done. Now the next concept is equalization levy. Now equalization levy was introduced in 2016 to tax online advertisement services or provision of digital advertising space or any other facility or service for the purpose of online advertisement. Now, this equalization levy is a tax which is deducted by the payee from the payment made for online advertising service from the consideration paid or payable. So it is a kind of, it is because it is a payment to the non-resident. So in form of TDS, this equalization levy is deducted for any online advertisement services. Now, this equalization levy was also introduced at the rate of 2% from consideration received or receivable or payable to a e-commerce operator. Now, this particular concept of 2% equalization levy on payment to a e-commerce operator was eliminated in the last budget with effect from 1st of October 2024. So as on date, as I'm talking to you, The equalization levy is applicable only on the online advertisement services or for provision of digital advertising space or any other facility or services for the purpose of online advertisement. But it is important to keep in mind that this equalization levy is deductible from the tax liability if the non-resident from whom the equalization levy is deducted has a permanent establishment in India. Another couple of points to be kept in mind is that it is applicable only if the threshold of 1 lakh is exceeded. And secondly, if the payment is done by an individual for personal purposes, then the equalization levy is neither required to be deducted and paid to the government. Now, as far as the calculation for consideration for equalization levy is concerned, the consideration shall include consideration for sale of goods, irrespective of whether the e-commerce operator owns the goods. Now, this is applicable for e-commerce operator, which is no more applicable now. But nevertheless, just to discuss the concept. And with respect to uh, advertisement, services for advertisement, obviously the entire consideration is subject to 6% deduction of equalization levy by the person who makes the payment of the tax. And the person who pays the tax is also supposed to furnish a return of the same, and so that the person from whom it is deducted gets the benefit of the taxation if it has a permanent establishment in India and he claims the deduction from his tax liability. So, friends, with this, I conclude today's session. If you have any query relating to today's discussion, then feel free to talk to me. Or you can also express any view of yours on these two topics which we have discussed today. If you disagree or if you have any other perspective on today's discussion, then you are free to express your view. Okay, it seems there's no question today for the from today's discussion. So, friends, next week I will not be available, but from next to next week I will start the discussion on the new income tax bill. So, I request all of you to start from the scratch, compare the new law with the old law, the jurisprudence in the old law, which you think will be applicable to the new regime, and let us have a very thorough and detailed discussion on the new income tax bill. Thank you very much.
Sir, I have not one question. I have one suggestion rather. Uh,
Right.
can we fix some sections? I mean, from this to this, we are going to do that because it's a half an hour and it's very good. Within half an hour, the person, I mean, time duration is also very limited. But it
Right.
will be better if we discuss in two, three pieces, new
No,
taxation
I
bill.
will, you see, what I would prefer is to do small discussions, because my feeling is that if we discuss too much in a day, then it dilutes the importance of the topic of discussion. So we'll do a phase-wise discussion, because you see now that we have been discussing this concept of residency and all since last two sessions. So most probably, let us start with the discussion on the residential status, because that is in any case the first point in the income tax law. And then we will discuss the concept of income, and you see the how the income accrues or arises in India, and so on and so forth. Then we discuss it, the head of income wise, and we try to understand the difference between this new law and how it was there in the old law, a comparison between the two, and also how the jurisprudence which is there in the old law will continue to apply to the new income tax bill also.
So just I want to humbly submit that we will not conclude in half an hour entire bill. That's my submission.
No,
We
no, no,
will
no.
have
That
a discussion
no,
for
no, no, no.
2, 3, 4 hours, four sessions rather.
No, no. In four session also it will not conclude.
Yes,
I think
exactly.
I think it will require at least 15 to 20 sessions. How can it be concluded?
Absolutely right, sir. Now we are on the same page. I am on same page as you are, sir. Thank you
Right,
very
right.
much. Thank you very
Okay.
much.
Thank you. Thank you.